Right, everybody. Ladies and gentlemen, hello and welcome to us here at Nadex. My name is Philip and I will be once again your presenter for today's webinar. Today we want to have a look at binary options. We want to understand what those binary options actually are and how we can use them to trade them in the markets, and what are the advantages of trading binaries when compared with futures, with forex instruments, with normal stocks, with all those other possibilities to trade the markets. Just as always, you can see that small questions box. Right now, I would appreciate a very short yes or why in that box to just let me know that both the audio and the screencast are working properly. And please, guys, we are running those sessions for you. We want to learn something here together. And for that reason, if you do happen to have any questions, please let me know. I do my very best to answer your questions as we move through the webinar. You are not interrupting my flow. You are not, that's not a distraction for me. This is not something which I don't like. Actually, I want to interact with you. So please give me those questions. Perfect. Thank you much, everybody, for the feedback. Really appreciate it. Yeah, today's session is scheduled to run for around about an hour. I have a tendency to talk too much, and I do my very best to try to move through the webinar in the proper pace. And of course, before we get started, there are our usual risk disclaimers. Please take a moment of your time to read through them and make sure that you're okay with them. Essentially, this says that trading, of course, involves risk, and you should understand those risks, and you should understand the instruments you're using before you're getting active in the market. This is what we are here for today. Neither Traders Position nor myself are investment advisors, and therefore nothing that we say should be considered to be actual investment advice. All examples are shown for educational purpose only. So please make sure you're okay with this. And here we have the Nadex risk warning. Nadex risk disclaimer: trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not necessarily indicative of future results. Nadex contracts are based on underlying asset classes, including forex, stock index futures, commodity futures, cryptocurrencies, and economic events. Trading can be volatile, and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to US regulatory oversight by the CFTC. That being said, let's get started. Today's webinar is brought to you both by Traders Position and Nadex, so I would like to kick it off with a very brief introduction of those two companies. Traders Position started back in 2006. Our founder, Nick McDonald, was happily trading the markets when suddenly his broker gave him a call and said, "Nick, obviously we can see your account, we see what you're doing there. Obviously you know what you're doing. Couldn't you please teach our other customers the way you are trading?" And this is how everything got started. We have been providing international trader training for clients of global brands, including exchanges and brokers worldwide since then. We teamed up with Nadex back in 2011, and as you have noticed by now, I'm not a professional presenter. Sorry about that, but I'm a professional trader, which means I trade those very same markets that you guys trade every single day. We're a company run by traders, for traders. I know this 100% to be true for all of my colleagues here at Traders Position. We have specialized in trading strategies, which means we have a structured approach to trading. We look at charts, we understand we have an idea of what we see on those charts, and we try to stack the odds in our favor. We try to collect as many factors supporting a trading decision, and only then, once we have our checklists all checked off, only then do we think about how can we actually now initiate a position in the market. The nice thing about that strategy approach is, once you have that proven strategy, any market, any time frame, it's really, you start looking for the same things over and over again. Nadex, of course, is a derivatives exchange subject to regulatory oversight by the CFTC, as we already heard in the introduction, newly formed in 2007, and just like all the other big market players in the financial industry, based in Chicago, financial heart of futures and options market. All contracts are settled in cash, no physical delivery, which takes a huge edge, a huge threat out of conventional commodity trading. You always have that risk, and you have to understand which contracts you're trading. You have to look at the contract spec to make sure that you don't have to take physical delivery of those markets that you're actually trading. This can't happen here with those Nadex contracts. All are settled in cash. At the same time, you have access to a very wide range of global markets to trade. Different stock indices from different countries. Forex products are available. Commodities, we had it in the introduction as well. The two types of contracts and two types of instruments that you can use for implementing your strategies here are binary options, which we'll cover in great depth today, and of course spreads. More on those spreads at a later time. Every trade now on all of your devices, obviously, I don't know about you guys. I like to trade in front of my PC or Mac. There I have all the charting that I need. I have everything that I need and can easily trade those markets using the Nadex platform in my browser. But if you're on the go, if you want to check those markets on the go, just monitor your position, analyze the markets, initiate new positions. Nadex has got you covered. You see those different platforms available. So why don't have a look around and try to install one of those platforms for your device and check out those mobile market access that's available there. Today's agenda, we want to kick off with an introduction to binary options. What are binary options? And once we understood what they are, we want to look at the benefits of trading those instruments. Why should we prefer trading options, binary options, compared to normal plain vanilla options, for example, or to futures? Or there must be some benefits, and sure enough, there are many. We want to have a look at them today. Understanding and managing risk. Risk management is really, really the biggest thing. One of the biggest things, let's put it that way, when it comes to really being successful in the long run. Risk management is boring as hell, but it keeps you in the game. You must make sure that you survive today's trading, because even if today doesn't work out, you want to still be in a spot to be able to come back again tomorrow and trade again. And this is what risk management has to provide you for. And the nice thing, or the great benefit of trading here at Nadex is you know your risk upfront. Risk management becomes so easy to implement using both spreads and binaries. You still must pay attention to it. You still must do it. But the complexity of applying proper risk management is so greatly reduced. It's become so easy to implement that proper risk management, and we want to cover that as well. Binary options in action. It's not just nice talk. We also want to have a look at charts and see how we can then pick the corresponding, and what are the benefits of picking different strike prices for implementing those strategies. And we want to close today's session with a look at how you can start trading at Nadex here today. So what are binary options? Those of you with an IT computer science background may know that term binary, a state of one of two mutually exclusive conditions, such as on or off, true or false, 1 or 0. And with binaries, we do just have that. It's either a 1, a true event, or it's either a 0, it's a false event. Where in the case of our binaries, it's either a 100 or a 0. And this 100 or the 0 is the payout. Like every other option, there is a point in time where we have to decide, or where the market decides, if the market price is trading at the strike price, above the strike price, or below the strike price. And with conventional plain vanilla options, it's a matter where the price actually is and how deep in the money, how deep out of the money price is. That complexity is reduced here because we just want to know, is price trading above the strike price or not? If it's trading above the strike price, it's true, and we get a payout of $100 for one contract. Or if it's trading below the strike price, the event is false and the payout of that contract is 0. So just two scenarios to monitor here. You can profit from both a true or false scenario because you can both buy and sell those binary option contracts. Now, a binary option represents a fixed risk and reward contract. It cannot trade below $0 and it cannot trade above $100. So you know precisely the range in which that contract actually will be. Maximum risk and reward are known and clearly displayed at the time of placing the trade. This is such a huge benefit because if you think you come, or if you're coming from a stock trading background, for example, you buy your 100 shares of Microsoft today, and yeah, the market closes and everything looks nice and dandy, and the next morning Microsoft opens up 20 points lower. That's horrible, and there's nothing you can do about it. And even if you had your stop loss in place, in a sensible place, and so on, proper position sizing, that huge gap overnight is really horrendous. It's really painful for your portfolio, and that's just a risk that you can't mitigate in any way. Here, with those binary contracts, you know upfront how much risk can be there. It's if the market gaps against you big time, you see the maximum loss that your position can take the very moment you're about to initiate that position. You know your risk upfront. You know absolutely the worst that can happen. And this is so powerful because this makes risk management really just a breeze. Those binary options will always expire at 0 or at 100. If it's trading above the strike price, then, or if the underlying market is trading above the strike price, it will settle for 100. If it's trading below or at the strike price, it will settle at 0. And this term, if it's trading at, there's actually an algorithm that calculates and determines how or where the underlying market is trading at expiry. You have to have a look at the Nadex website. There is a good explanation on how is it really the last, for example, for the S&P 500 is the last futures tick that is there, or is it some kind of averaging mechanism over the last few ticks? Yes, it is some kind of averaging mechanism. Please have a look at the website there. Everything is crystal clear. Everything is perfectly documented. So nothing unclear or hidden there. Each binary contract bought, sold represents $1 per point movement in the contract with a possible 100 points then for the final settlement. Now, if you have a background with normal plain vanilla options, let's compare those two to make sure that we understand what binaries actually are and why they give us a certain advantage when it comes to proper risk management. If we buy a conventional put, our reward is technically speaking unlimited. Yes, if we buy that put, we can profit all the way until the market goes to 0. So technically, yes, there is a limit, but usually this is such a huge move in a perceived way that reward is unlimited. The risk is also limited here in this scenario because now if we buy that put, we have to pay the premium, and if it doesn't work out, that's the maximum that we can lose. If we buy a call, we have an unlimited reward this time truly because this market can spike to infinity and beyond. And if it doesn't work out, our risk is limited because we know exactly what we paid, and this is the maximum that we can lose. Things start to become more interesting and way more dangerous when we look at selling puts and calls, because now our reward becomes limited. If everything goes according to plan, we can keep the premium that the buyer of this option has paid us. Our risk, however, becomes pretty much unlimited. Now we have to buy this. If we sold the put, we have to buy at the strike price, even if the market went to 0. Huge risk here on the downside if we sell that put. If we sold that call, same story. We have to deliver those shares at a price defined by the strike price, while this market might now be trading somewhere completely else. And if we have not covered that position, if we don't have those shares, we'll have to buy at market. Just think Tesla going to $1,000. We sold the call for $300 per share. We have now a $700 gap at risk per share, and one option contract for shares usually is for 100 shares. So huge risk here when selling options. Of course, you can manage all this. You can create more complex positions, but technically speaking, you must know what you're doing there, because otherwise, especially in the selling options here, you're in a world of pain. Buying a binary and selling a binary, you see, we're limited here. We have a limited reward, but we always also have a limited risk. And that's the huge benefit. We know exactly in which context we are operating, and we know all those numbers up front. We can easily calculate if it's worth the risk, what is the reward to risk ratio like? Does it make sense to pursue this any further? All this is known up front. As we said here, both the upside and the downside are known in advance. Binary option scenario, the price of a binary always and only trades between 0 and 100. So that's the highest price, that's the lowest price, and this is regardless of what happens in the underlying market. If the market shoots all the way up, way above the strike price, guess what? We stop at 100. If it drops way below the strike price, it can't go below 0. Once again, that's the price range while we are trading. And at settlement, at expiry, it's either 100 or 0, binary. So we are now looking at a virtual contract here with a price of 25. We can sell this contract now. We're looking at selling binaries. If we sold this contract at 25, what is our maximum reward? Well, if we sold it, we hope that price will decline. So we sell it at 25, and the maximum that it can decline to would be what? Would be 0. So our maximum reward would be 25. If things go wrong, how much can we lose on that contract? Well, we got 25 for it, and if it settles above the strike price, that contract will settle for $100. So we have to pay those $100. We just got 25 for it. So those 75 will be still be coming out of our pockets. So the maximum reward is just 25. The maximum risk is 75. And the reward to risk ratio on that trade is 0.33 to 1. Personally, I'd like to always see a reward to risk ratio on a trade of at least 1 to 1. It doesn't make much sense to me to think about risking 100 bucks or risking 75 bucks in this example just for the chance to make 25. That's not an attractive ratio. Let's put it like that. Things look differently if we have a look at selling that contract for 75. If we sell at 75, what's my maximum risk? Well, if price keeps on going higher and settles above the strike price, I will have to settle for 100. But I just got 75 here. So my maximum risk is just those remaining $25 per contract. My maximum reward, however, if price actually drops and closes at or below the strike price, I will be able to keep all those 75. And it doesn't matter how far price drops, because remember, if it's at the strike price or below the strike price, it will settle for 0 at expiry. So I'm risking now 25 for the opportunity to make 75. Now my reward to risk ratio suddenly is 3 to 1. I prefer that much, much more. We mustn't only go for a high reward to risk ratio. We have to balance things, but more on that later on. But in general, I want that number to be not to be below 1. Previously, we had a look at selling options. Now we look at buying options. Now I can buy this contract at 75, which means that market is already, or that option is already in the money. If it was just sitting at the money, price should be quite close, quite very near to 50. That's the usual ballpark estimate. Again, something very easy to remember, but very powerful, because then we can use later on proper limit orders and plan around those trades. If an option, or if the underlying market is trading near or at the strike price of an option, that binary contract should have a price somewhat around 50. It doesn't have to be 50, it could be 40, 60, something like that, but usually it shouldn't be 10 or 90. It should be very close to 50. Just keep that in mind. If we bought this in the option money, if we bought that in the money option, that's the correct way, I'm paying much more for that option. I have to pay now 75 bucks. What's the maximum profit? 25, because it can only go to 100 expiry. However, if market reverse, price drops below the strike price, that contract will settle for 0. I just paid 75 for something which will be 0. So again, my reward to risk ratio, I'm risking 75 for the potential to make 25. Reward to risk ratio 0.33 to 1. Different story if I buy an option which is currently out of the money. How do I know it's out of the money? It's trading, the market price is trading below the strike price while the price is below 50. Price has to travel still of that underlying market in order to get in the range where it could be worth something at expiry. And for that reason, that option currently is rather cheap. So I just have to pay $25. But if my strategy gives me an idea that I could expect some kind of move to the upside here, why not? 25. What is the maximum I can lose? Just the 25 I paid for it. What's the maximum I can make? The 75 difference to 100. Maximum reward 75 divided by the maximum risk gives me a reward to risk ratio of 3 to 1, which is much better, much more attractive than the one that we saw here in the upper example. Just a quick reminder, guys, if you have any questions, please ask those questions. That's what we're here for. Please don't be shy. We're looking here at an order ticket. Here is where we want to initiate our position on the platform. And first thing that we see is we see the underlying market, we see the asset class. We're looking here at a binary option on the S&P 500, on the S&P 500 mini futures. So US 500 September cycle, and here you can see if it was this index future, forex market, commodity future, cryptocurrencies, and so on. Denise is asking whether this session is recorded or was recorded. Yes, we are recording that session, and the recording will be shared with you guys. I think it will end up on the typical YouTube channel, for example, but you should be able to find those also on the website. But thanks for that question. Next thing to note here is we're looking here at the strike price. So the magical number is 2,107.5. If the market is trading above, you see the larger than sign. It's not larger equal, it's not smaller than, it's larger. It's always larger. Here we can see that the market has to trade above. One tick above that is enough after the settlement has been calculated. And that's it. Denise, I'm just getting the information that the recording will be shared with all those who have registered. So just check your email account with the same email address with which you signed up, and you should receive the link there to watch the recording. If you can't find that mail, maybe have a look in your spam folder. All right. So market, strike price, and next important thing: what's the expiry cycle? When is this contract finally settling? Expiration time and date chosen from hourly, daily, weekly expirations. You just pick those from the platform. So we're looking here at a option on the S&P 500, which settles above 2,107.5, and this settles at 4:15 in the afternoon. This is what we see here on that contract. This is what we're here looking at, what we are trading. Now, let's have a look at different strike prices and scenarios. When the underlying is trading at or near its strike price, the binary will usually be trading around 50. Guys, this is one of the most, I feel this is one of the most beneficial and crucial things to keep in mind, especially when it comes to managing that position. If that market is trading at the strike price, we should be somewhere around 50. if we initiate that position at this level, we are still sitting here at approximately a 1-to-1 reward to risk ratio. And this is still fine in my book. I can still work and live with that. I don't just like to risk more in order to make less. I'd like it to be the other way around, risking the same in order for a chance to potentially make the same. That could be okay for me. Now, if you think that the price will trade lower at expiration, you sell at 50. If you think price will trade higher at expiration, you buy at 50. Easy as that. Now, we're looking here at selling that contract. We see that the strike price currently is 2,107.5. We can see that the market here currently is trading at 2,094.75. This is currently the indication for the underlying market here using that Nadex algorithm. We are trading out of the money. Price will still have to travel around about 13 points in order to be in the money. So currently, if that contract was to settle now, if now was expiry, this would be worth nothing at all. Out of the money, therefore we can get it cheaper. If we sold this contract now, we can sell it for $6.75. What's the maximum profit that we can take here? Well, the maximum profit would be $6.75. We are able to keep what we get here, and that's not too much, because what is our maximum loss? The maximum loss is 93.25. 93.25, and you see this number here in the max loss section. How do we get that number? You just increase the position size here. You go from 0 to 1, and now you see my maximum profit and the maximum loss. You see all that directly here in the interface. You don't have to do any fancy calculations using spreadsheets and currency conversions and so on. It's all there. You see it on the screen immediately. And with our approach to risk management, you know how much money you're willing to risk on that trade. And therefore, it's easy to just tweak those numbers here until you approach that money amount that you're willing to risk on that trade. So seeing those numbers here for your desired position size, straightforward, very easy to do. However, if we are looking now into buying that contract, we can't buy for $6.75. Because that's the bid, that's the offer, that's the spread. You have to go through that spread. But if we are about to buy that contract, we can buy it for $13.75. So what's my maximum loss? I'm buying something now and it's worth nothing when the contract settles. So my maximum loss are those $13.75. The maximum profit, however, is that if the market keeps on going higher, this market shoots higher and moves above the strike price and settles above the strike price within those remaining 21 hours and 31 minutes. Then this contract will settle for 100. And this means it settles for 100. I paid $13.75. My maximum profit is $86.25. Definitely much, much better reward to risk ratio than that one here on that side. Absolutely not considerable for me for trading. This here looks much better, much nicer. What are the components when it comes to pricing those binary options? Probabilities. Trading is pretty much all about probabilities, and options clearly consider probabilities as well. The price of the binary is a constant reflection of the probability, all else being equal, of the true false event occurring. So in the previous example, we want to see that the S&P 500 is trading above, again, not equal, but above 2107.5 at 4:15 p.m., 675 to 1375. And if the contract is trading above that level, then the event is true. The contract pays 100. If it's trading at or below that strike price, then the event is false, and that contract pays exactly 0. Next component, expiration time. There's time value in options. Time value, theta, plays a major role. in plain vanilla option trading and option strategies, and definitely it's something also to consider here as well. If you think about volatility as being the speed of the market, the question is not only how fast are you, but also how long are you able to run. And this how long has the market now still time left in order to move. This is where this time value thing actually comes in. Time decay, if underlying market price remains below binary strike price, binary price will continually decline to zero at expiration, because with every ticking second, there is less and less opportunity for price to actually move in that direction. If it hasn't moved for the last 30 minutes and we only have 15 minutes left, it doesn't seem to be so likely that it starts to move now. However, if the underlying market price remains above the binary strike price, binary price will continually increase to 100 at expiration. Why? Because once again, if price is not really moving and it's currently sitting in the payouts territory, if it's sitting above the strike price in the area of 2 event, every second passed makes it more likely that it will remain there and will then be able to pay out those complete $100. A contract nears expiration, volatility increases if the market price is close to the strike price. If you think about it, we're sitting right at the strike price and we're trading one tick above the strike price. Suddenly it's worth 100. If it's ticking one tick down again and it's trading right at the strike price, the value is 0. And therefore, if now a lot of time is left, that doesn't mean a lot, because a lot of things can happen, a lot of time is still there. But if we just have 15 more seconds on the clock and it's flipping between those two states, one tick above the strike price and at the strike price, that value now clearly moves very fast from something like 10 to maybe 90. Volatility definitely increases there. Now, let's have a look at this example. Price is pushing higher. We're looking here at the 82 strike price. And the nice thing is, price is pushing higher and we're trading here right at the strike price. Well, trading right at the strike price, what do we expect? We do expect a price very close to 50. And sure enough, bid 49, offer 53. Price pulls back. Price pulls back and therefore price also declines. And we still know, however, that we're very close to the strike price, and sure enough, price didn't move very far away from that 50 section. We're sitting now at 49.59. Please also note that time is running out here. We are approaching more and more expiration, and here price shoots higher, and now with less time on the clock and now in the money, we're looking here at a 70 to 74 pricing scenario, and price drops down again, and it drops down again to those same levels that we had here before. Wait a minute, here we had a price of 45 to 49 and now it's just 30, 34. What's wrong here? That's this increased volatility. That's this move. We have less time in the contract, and therefore the pricing starts, those swings start to accelerate. The volatility becomes larger here. Therefore, currently price is only 30, 34, and price pushes higher again, and it moves again in that same territory where we already were. But guess what? Now it's not 70, 74, but 88, 92. Why? Less time on the clock. Less time for price to actually decline, less time for price to render this contract to the false event, and therefore higher prices. Price is pushing lower. Guess what? We're here trading at the money, and even then at the money we're looking at 48.52. Keep in mind this, if we're trading at the money, we're looking at a around about 50 price. And now price shoots higher again. We're going here for 82. Price is shooting higher again, and sure enough we'll settle here, and that contract will settle there for 100. Any questions here on this example of how the pricing of those contracts actually responded to those different and then again same price levels with less time on the clock? but I think we are good. All right, so let's move on. Contract expiration values. How does Nadex calculate contract values at expiry? Contract values at expiration is settled at 0 or 100. And here you have a rough summary for the for that algorithm. Emmanuel is asking, what time did it start? Answer 3P. Emmanuel, that shouldn't be that much of an issue here. It could have started way longer before here. It's really just the big takeaway here is if we're sitting here at the strike price, we're looking at 50. Doesn't really matter what candle size this is. This is really just approaching here. The idea is that it accelerates as we move into expiry. So Emmanuel, shouldn't really matter here. If that was a 2 hour, of course, if the contract on its own has a very short life cycle, you will see those fast swings pretty much from the beginning. If we're looking at a weekly option, for example, when it just starts trading, this is pretty much sitting idle and moving very, very slowly and very steadily. And these fast swings here, this is something that you can see over those last few hours and minutes of the contract life cycle. But thanks for that question. All right, what's the algorithm? Nadex takes the last 25 trades in the underlying market leading up to the moment of expiration. They throw out the 5 highest and 5 lowest trades. That's a common method used in statistics. You want to get rid of those crazy outliers. And then they average the remaining 15 trades. That's the value with which the contracts are being settled. Have a look at the website. It is explained there in much more depth and detail. And if you're curious, just have a look around. But once again, it's all very, very completely transparent. All right. Forex is handled a little bit differently. There is no central record. One thing with Forex, with all the other markets, you usually have centralized exchanges and markets, and you have times and sales data, and you can do all those calculations properly. Forex, no centralized markets, decentralized trading between large companies, banks, big players in the markets, investment funds, hedge funds, and so on. And therefore, you have to have a different approach here. Nadex takes the last 10 midpoints in the underlying market, and once again, removing the 3 highest and the 3 lowest, and then averaging the remaining 4 prices and rounds to 1 decimal point past the point position of the underlying market. Once again, have a look at the website for more details. So what are the benefits of trading binary options? First thing, if you can enter a position with a contract with a price anywhere between 0 and 100, then this is your minimum starting capital. And therefore, trading on Nadex can start with as little as $100. Not something that I would recommend at that stage. Once again, you want to have proper risk management in place. And having a small account makes it really difficult. But if you have $1,000 to get started with, I feel with those instruments available, not an ideal spot to start with, but you can definitely start with in a sensible and meaningful way to actually pay attention to your risk management. Just compare that with futures trading and the stock market. Those $1,000 will get you nowhere there at all. Big advantage, trading is a business. We want to keep the cost of doing business down. No platform fees or minimum trading requirements. Next thing, you just need a single account to trade all those different markets. Spot FX, commodity futures, index futures, all this is available, or access to those markets is available from just one single account. Invaluable supplemental tool for the experienced investor, and I feel that it's also a great introductory tool to the new markets or to new markets for the novice. Why? Because you can make risk management really spot on. Risk management is for survival. If you screw up your risk management, it doesn't matter how large your account is, you can be gone. Risk management here is the easiest I have seen anywhere. You still have to do it, but it's easy to do it. Low commission costs. To ensure profits are maximized, cost must be kept to a minimum, and therefore Nadex operates at competitive capped fee structure, 90 cents per lot with a maximum charge of $9 per order. Again, compare that to the cost structure for other markets independent of the much smaller capital requirements, and you can see that that the cost of doing business here at Nadex definitely is very competitive, to say the least. Simple trade execution. Trade execution is simple to understand. If you think price is going up, you buy a contract, and if you think price is going down, you sell a contract. It's not fire and forget. You can manage those positions. You can put in limit orders. You can take profits early. You can use stop loss orders. Again, it doesn't make, not again, we haven't discovered today, but I feel that it doesn't really is necessary or make sense to use stop loss orders, but you can do so if you want to. Take profit on part of or all of your open positions. You can have multiple limit orders sitting there. You can really actively manage your position, and therefore it's not important if we are in a bull market or a bear market. You can actually trade all of those market environments easily. Risk management. Simple money management gives you great flexibility. You can pick your order price and maximum potential risk. You see those numbers up front on the screen, and this allows for a high degree of control and flexibility. And the very nature of binary option contract is that the limit is built in. It limits your risk, and risk is always known in advance. Once again, no huge moves going against you, no slippage occurring, no nasty surprises. You know upfront the worst that can happen. And this makes it so easy to apply proper risk management. Overall account risk limited. When you place a trade, your maximum risk is clearly displayed, and this amount is then held as collateral. If you buy at 55, your maximum risk is 55 points, and $55 per contract will be held until the trade is closed out. The seller on the other side has sold at 55 and will put up the other $45. So in both cases, the exchange holds 100% collateral, or the full $100 payout that is possible on the trade. Once again, this means that you cannot lose more money than what is in your trading account. All contracts are cash settled, no physical delivery. Once again, Nadex is not your counterpart. Nadex is the exchange. You become a member of the exchange. You're trading there with other members of the exchange. Nadex is just providing you with a marketplace. Ease of access, trading worldwide markets from a single account. Index futures, the big markets here in the United States. You have the US 500, you have S&P 500, you have the Dow Jones, you have the Russell available for trading. You have in the UK the FTSE 100, the Nikkei. You have access to the German DAX, big indices. Why not? Why always concentrate on the home market? You can easily diversify with your trading there. Currencies, many different currencies, major pairs available for trading: Euro, US dollar, Swiss franc, Japanese yen. Commodity exposure as well: gold, oil, corn, silver, you name it. And events, non-farm payrolls, ECB rate, and so on. Which of those markets can be traded and what is the underlying market? I just leave it here up for a second. Doesn't really make much sense to really dive in there. And guys, all this information is also available here on the Nadex homepage. So have a look around there, and you see it's not some kind of farmer's market around the corner. It's really always the big market, the big underlying market. Clear structure, clear time and sales, absolute transparency once again for those futures markets. Same thing is true here for the indices. The Russell, Nasdaq, S&P 500, Dow Jones, FTSE, German DAX. Once again, all those are really the major futures exchanges here, where pricing information is taken from. So wide range of strike prices. We have hourly, daily, and weekly expiration cycles. And here, just as example for crude oil, you can see here in 50-cent steps per barrel the price that you are looking for as a strike price, which makes it easy for you to really pick those markets that you like to trade and with the proper strike prices that you want to use. Once again, Nadex is not your broker. Nadex is the exchange, and you trade with direct market access. You place limits at your preferred trade price. Even within the current bid-offer spread, you make the market. Your order directly shows up there in the order book. You can tighten those spreads yourself. You can actively participate there. It's not take it or leave it. No, you can put in your own offers. Benefit of trading here is also that stops are not required. Why? Because I know my maximum loss up front. Maximum dollar risk is known in advance if price moves against us. And we don't have to calculate that in any esoteric or advanced way that only geniuses will get. No, you see it here up front. Maximum loss 28.25. Maximum loss for that short position 28. You know your risk up front. You know how much you can lose. And for that reason, a traditional stop loss is not required. Why do we use that traditional stop loss? We want to cut our losses. We want to get out if things, if water starts to become too hot, we want to get out. The underlying price may go well beyond where our stop would have been if trading the underlying market, overnight gaps, fast-moving market, slippage, all this. However, due to trading a binary, the trade still has potential to be profitable, provided your level is achieved by expiration. If I'm stopped out in a conventional product, I'm stopped out. The position is gone. I've realized my loss. Hopefully, it was a small loss within my limits, but I've taken that loss. That trade, that game, that run is over for me. However, with that Nadex contract here, with the binary, price drops below my perceived stop loss level. I don't have a stop loss because I know the worst thing that can happen is I know how much money I can lose. That's okay, but I don't have to close that position there. And therefore, if price just briefly dips below my stop loss level and then just comes back again, and I'm pretty sure we've all seen that many times over and over again, guess what? That binary option still is worth something. Yes, very briefly, it went very close to zero. Doesn't hurt because we did our position sizing accordingly. But suddenly when it's coming back and we still have time left in this option life cycle, that contract can still be worth something. That contract can still settle at the end for 100 if the market plays along. So we are not being stopped out. We have all the time in that expiry cycle for the trade to still work out. The underlying might only justify a wide stop, big candle, or move well underway. Reward risk would be very bad in that scenario. But again, you can still get a very high reward to risk for the binary. Let's have a look at this example here. We're looking here at a crude oil weekly chart with a strike of 112.75. And we're looking here, the idea here is that price, our stop loss level, just a second, so our stop loss level here would be sitting here. Why would our stop loss be there? Because that's the swing point low. I think price might be going higher. However, that candle is so large, the proper stop loss location would be here. It just doesn't make sense to use that stop loss in this scenario. I can still easily just buy that contract here, and I know upfront what my maximum loss will be. I can still get a very decent reward to risk ratio here. Well, here 1.5 to 1 in the binary for just a very small upward move to 112.75 with no set stop, and our downside risk once again is completely capped at this level. So what happened next? Market started to trade higher. We are very near that, very near expiry now. The contract is now well in the money. We have started to move and push above that level here. We're trading right here in the middle, and we can easily trade that contract, manage that position, and close that position now at 96. Closing that position at 96, why would I consider that? Why not just wait for that contract to expire and give me the full 100? How much more can I gain by waiting? I can gain just 4 more points. How much can I lose by waiting? Well, technically I can still lose my $96. So if that's the scenario, there's nothing wrong with closing that position early on and say, okay, I don't care about those $4. It's good enough for me. I've taken the major part of my possible move. It's okay for me to close that trade here at that price level. Just full of thought, just to get you started there. Once again, it's easy to manage those positions. Understanding risks of binary options. Contract is trading at or near the strike price close to expiration. And this once again creates an extremely volatile change in binary price. Remember, that was the scenario where price actually starts to really fast move from 30 to 70, for example. And this is really often a matter of seconds. The comparison to plain vanilla options would be here the gamma risk of options trading with very little time left in the option life cycle. Trading at the money, gamma becomes huge, and therefore delta and price moves will really be immense. Same logic applies here. If the contract expires at or below the strike price, the contract settles falls at 0 and above obviously at 100. You don't want to have that risk. If you are in that scenario with things flipping very fast, why not put in a limit order, take profit and say, all right, it's flipping all the time between 70 and 30. Why not put in a limit order with 70 and be done with it? Take profit, nothing wrong with that. Price retraces before expiration. Price may have traded and exceeded your strike easily, perhaps trading at 97, 100 or 03. If profits are not taken at 97 or 3, you still have that risk of a sudden movement back above and below the strike price prior to expiry. Let's have a look at this example here. Short trade setup. We're looking here at a short entry. Strategy, momentum breakout strategy. We're looking here at a flat level. We're looking for a breakout of that flat level. We see that in the context of a downtrend, we see a setup that we want to trade, first step. And the idea is, yes, I want to trade that breakout of that level, and that level is sitting here at 74, a little bit more than 74,600. We could be thinking now that, all right, let's pick a strike price of 74.20. We can sell this contract now for 84. We want to sell a contract in the money because what is my risk on that trade? 16 bucks. How much can I make? 84. Nice reward to risk ratio on that trade. This is what happened next. Price went lower. Sure enough, we got our breakout. Very nice. We traded at the strike price. Where was this market at that point in time? It was trading here very close to 50. Why? Because it's trading at the money. It would have traded definitely below 50 here. But then price shot up again, traded above our entry price here, and with little time left, this would have clearly been a loss at that stage. So what was my initial risk on that trade? $16 per contract. If I was to take profit here with a limit order round about 50, I could have still made round about 2 to 1 on that trade, close that position completely or at least partially upfront, reduce my risk, or even close that position with a 2 to 1 profit. We don't always have to wait for that contract to expire. We have to, we can give it a lot of, we can take a lot of risk off the table by actually managing our position actively here. Price trades below strike but comes back above before expiry and now is likely to close for a maximum loss at 100. Possible solution, limit order to take profit at 50 or lower on a short position. Does this make sense, guys? We are running a little bit short of time. I'll do my very best to speed it up, but I feel that this is really a crucial concept here. So if you happen to have any questions here on that slide and the way to manage that position, don't worry about the momentum breakout strategy. We have other webinars to cover those strategies. Today it's really how can I play that setup and why would be going here for this take profit order with a price around 50, why this would make most sense here. All right. Time decay with a bullish bias. Buying an in the money contract puts time decay on your side, as we've said, while underlying market remains constant or goes up. Why? Because with every passing minute, probabilities are reduced. The market price actually moves against you. Buying an out of the money contract puts time decay against you, which must be offset by underlying market price increasing. Because every minute that passes where nothing happens, you have a minute less for price to move in your direction. In other case, ensure that the strike price in your view is likely to be hit or maintained. This is what I said in the beginning when I mentioned that I don't just want to think about reward to risk ratios, I also have to think about probabilities. I think that we are here in the context of a very nice downtrend. However, the recent low here was only a very, very small lower low. The next thing to note here is that the length of this move down and the speed is completely different to that, which makes it pretty sure for me that we see divergence here. First early warning sign. Then we start to see higher highs and higher lows. I start to see that those moving averages are crossing again. I feel that there might be some area here for price to pull back, but more on that in just a few minutes on the next slide. Binary options in action. A good exercise might be to just map those strike prices on your chart to actually visualize what does have to happen, how far does price actually have to travel in order to hit your strike prices. I want to have a good reward to risk ratio on a trade, but then not only that, I also want to have a fair chance to actually hit this price level and make sure that this contract has a chance to, in this pullback scenario, to give me my 100 payout. We're looking at that same example that we just saw 2 slides ago. Price is pulling back. We see divergence here. We see the next thing that this market is moving sideways and starting to push higher. Actually, we're starting to break out of a small level here as well. We think a pullback might be going on. Now, where might this pullback be taking us to? The 50 and 61.8% retracement areas are always good educated guesses if we can find more reasons why those levels might be interesting. And here we start to see a little bit of level building up around the 50. Could be an additional factor there. So we could be looking at the 12,100 strike in the Dow Jones, which happens to be the YM. If you're looking for the future symbols, Dow Jones mini futures. 12,100 strike, which is where we are pretty close here. We're looking here at a price of $40. We're looking at the 12,140 strike price. This is only costing $12, and the 12,160 is costing only $5.50 per contract. Quite close to the money, but not in the money. Therefore, price close to 50, but below. Far out of the money, very far out of the money. Therefore, the smaller prices. Now, if we think, now I have to think about how long do we have left for this price to actually work out. Here we have around about 2.5 hours left until expiry, and we're looking here at a 5-minute chart. So the question is, do we think on this chart that within the next 2.5 hours, price has a tendency, has a potential to really pull back? And if yes, how far can it pull back to? Those are the prices available here. And once again, the 50% retracement, this 50-61 area is always rather interesting. So which contract will you trade and why? This is what happened next. Obviously, if we went for that contract, which was already very close to the money, nothing wrong with that. Decent trade. A somewhat conventional reward to risk ratio on that trade. If we went for the one around the 50, that would have probably been one of the better selections. Why? Because it was still out of the money, far out of the money, and was costing just $12. And once we've hit this price level here, where should price have been at that point in time? 50. Why? Because it's trading at the money. Here, price pushed higher, pulled back, pushed higher again, trading now above that strike price of 12,150 and 140. And here in this area, price was very close here already at some point in time to the $97 range. Either way, you have risked about $12, and even if it's trading at 50, this is already around about a 4-to-1 reward to risk ratio on that trade. So this on its own would have made that a very rewarding trade decision and contract selection. Reward to risk on that trade 4-to-1 to 8-to-1. If we had gone for a higher level here, like the 12,160, yeah, it would have never been in the money. We would have traded very close to that price level. Here we might have approached the price of 40 or something like that, but actually taking profits on that trade would have been much, much harder. 12,120 would have been the easy one. 12,140, way more, or 12,100 would have been the easy one. 12,140, the logical, good, solid mid-ground decision. And this is what I'm shooting for. I don't want to have outstanding reward to risk ratio with a bad probability like the 12,160 would have given me. No, it should be balanced somewhere. It should have a decent probability for price to hit this level, and reward to risk ratio also should be nice here. Another scenario that you can do is a news trade, which means you're trading around a news scenario. News is just about to hit the wire, and if you, for example, think that prices might be going higher and you buy a binary which is just priced at 10, how much can you lose? You can just lose those 10. And now if price shoots up and closes above that strike price, you have a 9-to-1 reward to risk ratio on that trade. And the idea obviously is, if news is about to hit the wire, this market is about to become volatile. Here we have an example with a Fed decision, and we think the market has a potential, due to some background analysis, that we think 40 to 50 points here in the Dow Jones mini futures might be viable estimate. So going for that higher price, picking one of those contracts here, and just a few minutes later, really price shoots up to those levels. Once again, price spiked higher. We can close that position early on, or we can take the risk and say we want to wait. Or we close part of that position and take some risk off the table. Maybe have a risk-free trade on now, because we have realized already as much profit as we are still risking with the ongoing trade. And sure enough, this is what happened next. We got the breakout, price continued to push higher, and this would have settled now for 100 at expiry. Do we have to wait until expiry? How much more can I make? It's trading at 98 bid. Yeah, I can make just $2 more by waiting. How much can I lose by waiting? 98 if price suddenly starts to break apart. I would definitely close that position here at 98 early on and not leave that money on the table. Another example here, we have a uptrend, we have a pullback, and we're sitting now here in this range-bound area, and several touches. We're about to break out here. And once again, which kind of price level do we want to take? And you see those different bids here for those different prices here. Once again, we're looking for a decent reward to risk ratio. And depending on which contract you would have taken, obviously a little bit out of the money, maybe not directly the profit target level itself, a decent reward to risk ratio would have been achievable, and would have been achievable here as well. Let's wrap it up, guys. Sorry for being over time. Big takeaway here, binary options are easy to understand. They provide us with a fixed risk without a traditional stop loss. Our risk is known up front. We can trade a global range of different markets, foreign exchange, indices, commodity futures. We can trade news. We can trade cryptocurrencies. Nadex provides the trading platform with full direct market access and execution. Minimal capital outlay, no outlay. Contracts are available for under $100. Obviously, you want to have proper risk management, so don't just start with 100, but compared with other types of market access, you can really start very, very small here. High reward trading with limited downside, your risk is always kept. Guys, thank you very much for tuning in today. Really appreciate you guys taking the time. If you happen to have any further questions, please let me know. This was all theory. Have a look yourself. You see here on that slide, it says a 14-day demo account is available. Guess what? It's no longer a 14-day demo account. It's an unlimited demo account. Take your time. Play around with the platform. It costs you nothing. Register for that demo account, please, and give it a try. And you will see within a few minutes how easy it is to access those markets and really get a hang of how those products actually work. I think it's time wisely invested and get used to the platform. Just play along with it. Eric, thank you very much for the feedback. Guys, really appreciate the feedback. And yeah, thank you very much for tuning in. Sorry that it was a little bit rushed towards the end. And yeah, any feedback as always is appreciated. And now to all of you guys, have a great day. Happy trading, and yeah, catch you next time.